Chapter 15. Non-performing loans and restructuring. Non-performing loans, or NPLs, are loans on which the borrower has failed to make scheduled payments for a specified period, typically 90 days or more. NPLs represent a significant risk to banks, as they tie up capital, reduce profitability, and may result in credit losses. Section 1. Classification of NPLs. Regulatory frameworks typically require banks to classify loans into different categories based on the borrower's repayment performance. Common classifications include standard or performing loans, where the borrower is current on all payments, special mention loans, where there are early warning signs of potential problems, substandard loans, where repayment is in doubt and collateral may not fully cover the exposure, doubtful loans, where repayment is highly unlikely, and loss loans, where the loan is considered uncollectible. As a loan moves through these classifications, the bank must increase its loan loss provisions, setting aside capital to cover potential losses. Section 2. Causes of NPLs. NPLs can arise from various factors. Borrower-specific factors include poor management, business model failure, or fraud. Industry-wide factors include sector downturns, such as a collapse in commodity prices. Macroeconomic factors include recessions, currency crises, or interest rate shocks. Bank-related factors include inadequate credit assessment, poor monitoring, or overlending. Understanding the root cause of an NPL is critical for determining the appropriate remedial strategy. Section 3. NPL management strategies. Banks have several options for managing NPLs. Restructuring involves modifying the loan terms to make repayment more feasible. This may include extending the tenor, reducing the interest rate, or converting debt to equity. Recovery involves enforcing collateral, initiating legal proceedings, or negotiating a settlement. Write-off means removing the loan from the balance sheet and recognizing the loss. Sale involves selling the NPL to a third party, such as an asset management company, at a discount. The choice of strategy depends on the borrower's willingness and ability to repay, the value of collateral, the cost of recovery, and regulatory requirements. Section 4. Loan restructuring. Restructuring is often the preferred option when the borrower is facing temporary difficulties but has a viable business. The restructuring process involves assessing the borrower's financial position and repayment capacity, negotiating new terms that are sustainable for the borrower, documenting the restructured facility, and monitoring the borrower's performance under the new terms. Restructured loans are typically classified as NPLs until the borrower demonstrates consistent repayment performance over a specified period, often 12 months. Section 5. Collateral enforcement and recovery. If restructuring is not feasible or the borrower is unwilling to cooperate, the bank may need to enforce collateral. This involves taking possession of pledged assets, selling the assets through auction or private sale, and applying the proceeds to reduce the outstanding loan balance. The recovery process can be lengthy and costly, especially if legal proceedings are required. The loan management system must track all recovery activities, including legal actions, asset valuations, and sale proceeds. Section 6. Provisioning and write-offs. Regulatory frameworks require banks to maintain loan loss provisions to cover expected credit losses. The provisioning amount depends on the loan classification and the value of collateral. For example, a substandard loan may require a 25% provision, while a loss loan may require a 100% provision. When a loan is deemed uncollectible, it is written off, meaning it is removed from the bank's balance sheet. Write-offs reduce the bank's capital and profitability, making NPL management a critical priority. This concludes Chapter 15. Non-performing loans and restructuring.